My name is Sid Mendelson. I'm director of the division. On my right is Dick Grant, special counsel to the director, and on his right is Gene Golke, a senior financial analyst in the division. I would like to clear up some ambiguity from the previous tape relating to 17E. Section 28E of the of the 1934 Act allows a money manager to select brokers and pay additional fees when he, in good faith, determines that those brokers can either give good brokerage services, or such broker is providing good research services. Now, I'm paraphrasing 28E. That determination must be made in good faith. In other words, a money manager does not have to go to the cheapest broker possible, what is known as a discount broker. He doesn't have, if he in good faith thinks another broker which will charge more but will provide good brokerage services or will provide research. Now remember, the determination must be made in good faith. Now, it could be interpreted under 17E that where brokerage is directed for the purposes of research, that the investment advisor is receiving compensation. It has not been interpreted that way. The theory being that the research will go to the benefit of the funds, and therefore, except in circumstances which are aggravated, where it's obvious that the investment advisor is paying for research which under ordinary circumstances he should be providing to the fund. Except under those circumstances, we would not consider that the direction of brokerage, even at a higher price for research, if done in good faith, is compensation to the investment advisor. With that, I'll turn the rest of the program over to Dick Grant.
Thanks, Sid. Gene Golke and I are going to talk about Section 12 of the Investment Company Act, which places some limitations on some business activities of investment companies. Generally speaking, we're talking about limitations on certain trading practices, limitations on investment company activities as a distributor of its own shares or as an underwriter, limitations on investment company investments in other investment companies, in broker-dealers, insurance companies, investment advisors, and venture capital companies. Gene, why don't you start off by talking about some of the trading practice limitations?
Okay, the first section or paragraph of this section I like to talk about is 12A, and 12A in effect provides that it would be unlawful for registered investment companies, in contravention of any rules that the Commission may adopt, to purchase securities on margin, to be part of a joint trading account, or to sell securities short. Now, the important words here are in contravention of Commission rules. There are not any rules. In the late 1960s, 2 rules were proposed to, counter some of the speculative activity that was occurring at that time. Those rules were never adopted. So you might say, well, no rules, fine. Investment companies can do any of these things. Well, it's not quite that simple, because the way the staff has interpreted the effect of margin purchases and short sales, Section 18, which will be discussed immediately after this panel and concerns senior securities, has or impacts the ability of funds to engage in these types of activities. Now, it may be helpful before we look at how Section 18 impacts margin purchases and short sales to see what, in fact, we are talking about. First, what is a margin purchase? In the typical securities transaction involving an equity, the customer will contact the broker. The broker will purchase the securities, and within 5 business days, the transaction will settle. If the customer purchased, the customer will come up with the full amount of cash required to pay for the securities, and that will be the end of the transaction. In the margin transaction, in contrast, the customer will borrow a certain percentage of the cost of the securities from the broker. The maximum percentage the customer can borrow is governed by Regulation U, put out by the Federal Reserve Board. And the Federal Reserve varies that percentage which can be borrowed based upon its perception of the conditions of the market, the speculative activity taking place in the market. At least. Now you might ask, why would anyone want to borrow money from a broker to pay in part for securities purchased? I suppose the main reason is to leverage one's portfolio. The idea of leverage is to acquire an asset base greater than what your own means would permit you to acquire, and then attempt to benefit from a gain on that larger asset base. For example, suppose you wanted to purchase 100 shares of a security selling for $100. Well, that would cost you $10,000. And let's suppose that security should increase by 10%, $1,000. Well, you would have a 10% gain. $1,000 gain, $10,000 investment. Now let's suppose you borrowed 50% of the cost of that security from a broker. Your investment would be $5,000. You would still own 100 securities, so your gain would be $1,000. In dollar terms, in percentage terms, it'd be 20%. Of course, you'd have to pay the broker interest on the funds borrowed, but generally the potential for capital gain greatly exceeds the amount of the interest paid.
Gene, you said your gain would be 1,000. You really meant 100, didn't you?
No, 1,000.
No,
1,000.
You're buying 100 shares, and I'm assuming 10% gain
Oh, excuse me.
on 100 shares.
Gene, with respect to, you indicated Regulation U. Doesn't Regulation T also come into play here?
It could very well.
Yeah.
So, margin purchase are done to, or in an attempt to leverage one's portfolio. Of course, they're not risk-free because leverage works both ways. It can help you on the upside, but it can also harm you on the downside. If the security, for example, that you purchased on margin should decrease by 10%, your loss would be 20%. And also, whenever you purchase anything on margin, if the price of the margin security should decline, there's always the possibility the broker will make a so-called margin call, ask for additional collateral to secure the borrowing. If you can't come up with it, the broker will generally sell the security at the then lower market price, and you realize your loss. A short sale. First, let's look at the usual transaction. You own a security, you decide to sell it. Again, you inform the broker, sell 100 shares of IBM, for example. 5 business days later, you go to settlement. You give the broker your 100 shares of IBM, and you get your cash price. In contrast, the short sale is when you sell a security that you do not own. So, for example, you don't own any IBM securities. You call the broker and said, tell them I want to sell 100 shares of IBM short. The broker sells. On settlement date, the broker will borrow securities from another of his customers, perhaps, to make good on the delivery on settlement date.
I have heard it said here on previous tapes the expression selling short against the box.
I was going to get to that, but I might as well cover it right now. Another way of selling short would occur, let's say, in these circumstances. Again, let's suppose you own 100 shares of IBM, but you purchased it many years ago. So you have a very substantial unrealized gain in IBM. And because of current market conditions or whatever, you feel that the upward potential for those shares is somewhat limited in the near future. And in fact, you believe the price is going to decline. But you do not want to sell the shares you own and have put aside in your lockbox, safety deposit box, because you do not want to realize that substantial unrealized gain. So what you might do there in those circumstances is, again, tell the broker, sell 100 shares of IBM. I will not deliver the shares I own. Instead, you go and borrow shares to make good on the delivery. And what, in the term of art, I guess, here is that you're selling short against the securities you have in your lockbox. You're selling short against the box.
Why is that done?
Well, it's to profit from your anticipated price decline in IBM shares without, at the same time, realizing the substantial unrealized gain that you do have in the shares you own.
Of course, it can limit to a degree your risk of market fluctuation in that you do have securities available to make delivery if necessary.
And if the risk, of course, in selling short is that you'll be wrong. Instead of the security going down in price, something unexpected happens and it shoots up, and you then have to replace the securities you sold short, let's say at 50, at maybe 70. In order to make good the securities you borrowed from the broker. So really, when you sell short and do not simultaneously own the securities, you really have unlimited risk on the upside.
As a matter of fact, also, isn't it done quite frequently to postpone the capital gains from one fiscal year to another? In other words, you sell short in January,
Or in December.
In December, because if you sold the stock long, if you will, and delivered it, you would suffer a capital gains in that period. Whereas if you sell short in December and cover in January with the same shares out of the box, the capital gains would be postponed to the following year. Is that correct?
I believe you could follow some sort of tax timing procedures here through the use of short sales.
There's a question? Yes.
When you sell short, do you pay the broker a fee for the use of the security, a credit?
Oh, yes.
You don't pay
Repeat the question.
an interest charge.
You don't pay.
The question was, when you sell short, do you have to pay the broker a fee or any other type of, or incur any other type of cost for that, for the borrowing of the securities? Of course, you pay the broker the commission rate you negotiate. In addition, you would have to make good any dividends declared on the stock you borrow.
You also pay them. It works this way. It works the same as the margin requirements. If you sell a stock short, let's assume the margin requirements are $50, 50%. You would have to give that broker $50 or any other maintenance amount that he demands. But if the Federal Reserve regulations say 50%, the minimum you would have to give him is 50%.
Basically, you're borrowing from him, and you've got to provide collateral.
And you provide collateral. Now, in addition, you pay interest on that on that to him, plus the fact that when he sells the stock, he receives the proceeds, which he keeps until the security is until the transaction finally clears. In other words, till you remove the short. So he has the collateral, which is the proceeds from the sale, plus your margin requirements, plus your interest, plus your brokerage.
But you're saying that the margin requirements are the same whether you're buying on credit or selling?
Normally, yes.
Perhaps just to clarify, you can also sell short on margin, which I don't think I should get into now, but I would guess the typical short sale, you sell 100 securities short, and as Sid said, the broker will keep the entire proceeds from that sale. And in addition, you have to provide additional collateral to that broker in form of either cash or government securities. I'll cover that a little bit later in discussing how an open-end fund can get around the senior security problem with a short sale. Reggie?
Yes, Gene. You explained some of the advantages in selling short. You also mentioned selling long, and conceptually, it's hard for me to understand where the advantage would be there for someone who is dealing in securities.
Question was that I've explained some of the advantages of selling short, but you can also sell long, and what are the advantages of selling long?
A long sale is the normal securities transaction. You simply sell the security. Selling short involves a certain risk because you're assuming when you sell something you don't have that when it's time to deliver, you'll be able to get it at a lower price and make a profit. But you can also lose because the price goes up in the meantime.
In other words, selling long is just a normal.
Just a sale.
Just a normal.
Right.
It means you have, long means you have the stock.
And of course, when you sell long, you incur any, up to that time, unrealized gain or loss that you might have. Whereas if you sell short, you simply sell at the current market price, and then your gain or loss is determined upon what you have to pay to acquire those securities at some time in the future, either above or below the price at which you sold them. And of course, if your expectations are realized, that is, the price of the security declines subsequent to the date they're sold short, of course you can buy them back. Let's say you sold them short at 100, you buy them back at 90, so you make $10 a share. Now, I think you can see in either the margin transaction or the short sale, the person, in this case the investment company, is borrowing something from the broker-dealer. And it's because this borrowing takes place that Section 18 impacts a fund's ability to undertake these transactions. Both of these borrowings, as the staff has interpreted them, give rise to a prior claim on the investment company's assets. That is, the investment company would have to use its assets to cover the short sale or to pay back the margin account before it could, say, liquidate and distribute monies to its common shareholders. So there's a prior claim on the fund's assets. Okay, then how does Section 18 then impact margin accounts? And I won't get into 18 in too much detail here since it will be covered in the next panel. But in general, Section 18 prohibits borrowings by open-end funds, except that open-end funds can borrow from banks as long as such borrowings are covered by 300% have a 300% asset coverage, and we'll talk about asset coverage somewhat later. And also, open-end funds can borrow for temporary purposes. So, with those prohibitions and those exceptions, an open-end fund cannot have a margin account with a broker-dealer. However, the open-end fund can borrow from a bank as long as it maintains that required asset coverage and use the funds borrowed to purchase securities. So an open-end fund can, in effect, engage in margin transactions, but it must borrow from a bank, and I think generally the rate of interest the bank would charge would be higher than what the broker would charge. But an open-end fund can engage in a margin transaction. Closed-end funds can borrow from persons other than banks. Closed-end funds can also issue debentures, bonds, preferred stock, so that a closed-end fund can also engage in margin transactions and can in fact have a margin account with a broker-dealer. Short sales. How does Section 18 impact on short sales? A short sale again creates a senior security, the obligation of the fund to repay or to purchase the securities borrowed and give them back to the broker-dealer. Of course, open-end funds are prohibited from selling short except where there's adequate coverage of the borrowing. Now, what are the coverage requirements? Or, in other words, what must the open-end fund do in order to be able to sell short? Well, first of all proceeds from the short sale must remain with the broker-dealer, as Sid mentioned before. In addition, and this could vary from broker to broker, but in general, the broker would require the fund to deposit with the broker as additional collateral an amount equal to the market value of the securities when they were sold short. So in effect, the broker would have twice as much collateral as the value of the securities sold short on the day they were sold short. In addition, the broker would require the fund to mark that collateral to market, so that any time in the future the broker would continue to have 200% coverage, so to speak. Now, if the fund is not required to deposit additional collateral with the broker over the proceeds of the short sale, then the fund, based upon requirements proposed by the Commission, must establish a segregated account with its custodian and deposit in that account cash or U.S. government securities, so that when you add the proceeds of the short sale and additional collateral deposited with the broker, plus the amount in the segregated account, the short sale will be covered to the extent of 200%.
Let me tell you why we did this. Since the requirement of Section 18 is that a open-end investment company can borrow only from the bank, obviously a short sale is borrowing from a broker, which was prohibited. So we first required that the investment company, in addition to the proceeds and in addition to the margin requirements which the Federal Reserve had required, that he would have to deposit with the broker that amount of extra money to equal the purchase price, so that if the broker, in effect, borrowed, if he sold one security, we'll say, for $100, the broker would borrow $100 worth of securities. $50 if the margin requirement were 50%, the investment company would have to pay leave $50 with the broker. The investment company would then, according to our initial requirements, would have to put another $50 with the broker. And what did that do? That offset the borrowing. So as a practical matter, there was no borrowing from the broker at all. The broker borrowed $100 security in the name of the investment company. The investment company handed $100 to the broker. And thereafter, should the security start to go down, there would have to be a mark to the market. If the securities went down to $99, another dollar, for example, would have to be given to the broker. So that at no time was the investment company indebted to the broker, even though the broker may not require any additional collateral more than the 50% margin requirements in our hypothetical case. We said he had to give the other $50. The only problem with that was that the brokers went under, and with it went the extra $50 of that the investment company had deposited at our suggestion. And this was hardly the way to protect the public. The investment company would then be a general creditor of the broker. So instead of being a purist, we changed our minds. We said, yes, you have to pay the $50 to the broker with respect to the margin. You have to pay him any additional money that he requires from all other customers for the similar transactions. But with respect to the difference between the $50, if that's all he required, and the $100, you have to put that in a segregated account. And you have to mark that to the market. I made a mistake before when I said if the stock goes down, you have to pay an extra dollar. In a short sale, it would be just the opposite. If the stock went up, you would have to pay, because there you would be buying back at 101 for that which you received $100 for. So you would have had to mark to the market if the stock goes up. In a margin account, you mark to the market if the stock goes down. In a selling short transaction, you mark to the market if the stock goes up.
And I think, though, even in a short transaction, you do not mark to the market below the price at which you sold the shares. You mark to the market up. You can backtrack to the price at which you sold them, but I don't think you can go below that price. And reading through the various no-action letters, I found that at one time the staff was saying that the open-end fund cannot have more than 35% of its assets securing short sales. I'm not sure that's still a requirement or not.
I think we're reviewing that particular provision.
And of course, another way for an open-end fund to cover a short sale is to sell short against the box, which I described before. As long as you own the securities, then all that you need, as far as I can tell, is to have the broker maintain the proceeds, plus perhaps put up the margin requirements. Yeah. Beyond that, you do not have to establish the segregated account. For a closed-end fund, either it would meet the asset coverage requirements, which we've just been talking about, or else it could simply meet the general asset coverage requirement for borrowing under Section 18. So a closed-end fund could engage in short sales with a bit more leeway, if you will, than a open-end fund.
We used an expedient here, allowing the funds to go into this speculative activity if it wanted to, but only to the but it continued to tie up its assets, and its and the amount of leverage which it could use was limited. And as we'll get into Section 18 a little bit later, one of the purposes, and if you go back to 1B, one of the purposes of the Act is to prevent excessive borrowings. So by forcing the fund to put money aside, to stagnate money, we took away the leverage aspect of the situation, and thereby we thought we were complying with the spirit of Section 18 and certainly the spirit of Section 1B. Go ahead.
Are there any other questions on margin accounts, short sales?
There is a recent release out with respect to futures, Ginnie Mae futures. You know the number of that release? Well, I would suggest that there is quite an exhaustive discussion of all this type of transaction, and I commend your reading of that release.
It is Investment Company Release 10666. It was, effective date was April 18th, 1979. Okay, if there aren't any other questions, Dick, why don't you go on?
Okay, I'll discuss Section 12B, which gives the Commission the authority to regulate circumstances in which an open-end investment company, or for convenience, a mutual fund, acts as a distributor of its own securities, except where it's acting through an underwriter. And as we get into it, you'll see there'll be some discussion of what exactly does distributor mean, since it's not defined anywhere in the Act, and when is an investment company acting through an underwriter or not acting through an underwriter. There are no rules under this section presently, but Section 12B has been the focus of a good deal of debate in recent years as a result of a controversy over whether mutual funds should be able to incur any expenses in connection with distribution of the shares of the mutual fund. As you already know, investment companies or mutual fund shares are sold at net asset value plus a sales charge. It used to be that the distribution function, because of these sales charges, was a profitable one, but for the underwriter and the dealers. But because of changes in the market, it really has not been in this decade, the decade of the 1970s. There are a lot more no-load funds now in which there are no sales charges, and in addition, the equity markets have not been strong in this decade, and so it hasn't been that easy to sell equity funds. As a result, investment advisors have been frequently subsidizing the cost of distribution out of their management fees that they get for advising the funds. Needless to say, that cuts into profits. And so, largely at the instance of investment advisors, there's been a movement to permit mutual funds to pay part of the distribution costs. Now, that might not seem like such a controversial issue. For the typical company, issuing new shares means raising capital, and that's usually considered a rather vital function. But there are a couple of problems in the area of mutual funds. Since mutual funds are nothing but a pool of securities of other companies, it isn't always that clear that issuing new shares and thereby getting more capital into the investment company is that good. It may be good for a very small fund to reach a certain size at which it becomes viable, because below that size there isn't enough money generated by the fees to make it profitable for the investment advisor, or the expenses, which are normally, in many cases, fixed, are too high. On the other side, very large investment companies may get some advantages out of continuing to grow, because in many cases there are breakpoints in the investment advisory fee. It might be 0.5% of assets up to $100 million, but 0.4% of assets above that size, or something like that, so that if the fund grew to a significant size, the advisory fee would be proportionately lower. In addition, to the extent that some expenses are fixed, those fixed expenses would be allocated over a larger base, so that the fund would enjoy these economies of scale. There's also been some discussion of whether it's detrimental to an investment company, a mutual fund, to decline in size. Because of the mediocre or poor performance of the equity markets, equity funds have experienced net redemptions, more people getting out than getting in. And it's been argued that that creates a negative cash flow, which reduces the investment advisor's flexibility in managing the portfolio, because you might have to sell off stock to make a new investment rather than be able to have cash on hand to make a new investment. There is no proof positive that having a negative cash flow like this harms the performance of an investment company. And for that reason and other related reasons, it isn't at all clear that growth or failure to decline benefits the shareholders, existing shareholders of a mutual fund, meaning that the benefits of having an investment company pay for its own distribution are somewhat speculative. You just can't ever be sure. In addition to that, there's a tremendous problem of conflict of interest. Since the investment advisor is paid on the basis of a percentage of assets, he clearly benefits if the investment company grows in size or does not decline in size. And since typically the investment advisor dominates the affairs of the investment company, he may have an incentive to overreach. For that reason, the Commission has taken the position that it's generally inappropriate for a mutual fund to incur any expenses in connection with distribution. At the same time, the staff and the Commission have been discussing the possibility of permitting investment companies to finance distribution under highly regulated circumstances. And if any such regulations come out, they would be under Section 12B, since it's the Commission's view and the staff's view that if a mutual fund incurs expenses in connection with distribution, it is thereby acting as a distributor. And the fact that it may also have an underwriter does not deprive the Commission of jurisdiction, even though Section 12B says the Commission has rulemaking authority except where the fund sells through an underwriter, because that exception is clearly intended to deal with a normal underwriting situation, which in the case of mutual funds means the underwriter gets the stock at net asset value and then tax on a sales charge. It does not mean that anything comes out of the assets of the investment company. Section 12C regulates to a limited extent the activities of a diversified investment company as an underwriter. As you remember, a diversified company is supposed to have its assets invested very broadly over a wide spectrum of securities. Section 12C provides that an investment company can't make an underwriting commitment if the value of the commitment, together with investments of more than 10% of the investment company's assets in another issuer, or 10% plus 10% plus 10%, would add up to more than 25% of the assets of the investment company. That's just designed to keep not to let underwriting commitments let the fund become too concentrated. As a practical matter, this section really doesn't come into play because typically investment companies rarely do any underwriting. Section 12D places limitations on investment companies in other investment companies. The provisions are a little bit complicated, but to try to get to the heart of it and make it relatively simple, an investment company, together with companies controlled by the investment company, can't make an investment in another investment company amounting to more than 3% of the voting securities of the other investment company being acquired. In addition, an investment company can't invest more than 5% of its own assets in any one investment company, nor can it have more than 10% of its assets in investment companies generally. That's Section 12D1 capital A. Section 12D1 capital B is sort of the flip side of that requirement, and it applies to the company whose securities are being acquired. It provides that such a company cannot knowingly sell its shares to another investment company if more than 3% of the acquired company's securities would be acquired thereby, or if all investment companies would own more than 10% of the acquired company's securities. Section 12D1C applies only in the case of closed-end companies, and it provides that no investment company or group of investment companies in a complex can own more than 10% of the shares of a closed-end company. Basically, all these limitations are designed to prevent the excessive pyramiding of investment companies on top of each other. If that kind of pyramiding occurred, not only would it enable the small group at the top to control a lot of investment company assets, but it would also duplicate a lot of management fees and other expenses, in the sense that the fund at the lowest level of the pyramid is paying fees, and then if you're an investor owning shares in the fund at the next level of the pyramid, you're paying directly the fees of the fund that you own, but you're also paying indirectly a share of the fees of the fund underneath.
Now, this all came about as a result of fund of funds and IOS, the European fund that was buying American funds in the United States. And as I told you in a previous tape, the pressure that was brought to bear by fund of funds, controlling the management, if you will, certainly the brokerage of the American funds, with always the threat of redeeming, being used as a weapon to get what they wanted from the funds. The result of this was these provisions in Section 12, which were in the 1970 amendments.
Okay, to just summarize very briefly then, investments by investment companies and other investment companies are strictly limited because of concerns about possible subdelegation of the management function, and because of the concern about duplication of costs and expenses. Section 12D1 does provide for some exceptions, and maybe, Gene, you'll run through those.
There are, I think, basically 3 exceptions which permit one registered investment company to purchase shares of another registered investment company, or at least own shares of another investment company. 12D1D provides that if, for example, a investment company owns 3% of the shares of another investment company, and it should get a dividend from the acquired company, or it should get in shares, a stock dividend from the acquired company, or it should get additional shares of the acquired company through an exchange offer or through a plan of reorganization, that it can continue to hold those securities even if it should be over the 3%. However, if the acquiring company has the option of choosing shares or cash, if they choose the shares and that takes them over the 3% limitation, then at least in one instance the staff has required them to dispose of those shares. So there is some provision then for going over if it's received as a stock dividend or, say, as an exchange offer. Also, Section 12D1E, I guess you might call it the unit investment trust exemption, at least it in part applies to a unit investment trust, which is, I'm not sure it's been explained before, an investment company that whose primary security, at least in this case, is a share or shares of one other investment company. For example, an underwriter or broker-dealer will set up a periodic payment plan type of situation, or various types of accumulation plans which permit shareholders to mail in payments monthly or quarterly to the unit investment trust. The unit investment trust will take those payments and then reinvest them in the shares of one mutual fund. 12D1E permits this type of company to exist so long as the depositor or principal underwriter of the unit investment trust is registered under the 34 Act, and the unit investment trust holds only one security, or holds the securities of only one investment company primarily. This same section also provides that if an unregistered investment company, such as a personal holding company, is acquiring the securities of a registered investment company, it can only do so if provisions are made that in voting any proxy, the unregistered company will either go to its shareholders and have them inform it how it should vote the proxy, or else it will agree to vote its shares in the same proportion that all other shares of the registered company are voted. And also it has to refrain from disposing of the shares of the registered company without until it gets commission permission to sell them. And finally, 12D1F, I guess you might call this the fund of funds exemption. It permits one registered company to own up to 3% of the shares of another registered company, so long as the sales load of the acquiring company is 1.5% or less.
This is the loophole that both FundPAC went through and First Multi-Fund.
In other words, the 5% of the acquiring company and the 10% of the acquiring company test don't apply to this type of fund.
However, to avoid the pressures of the, Sid mentioned in the iOS situation, of having the acquiring fund direct the brokerage or whatever of the acquired fund, the voting of proxies must be followed in the same manner as I just mentioned for the, say, the unregistered fund. That is, FundPAC would have to go to its shareholders and ask them how it should vote proxies of its portfolio investment companies. And also, the section provides that the acquired fund does not have to redeem any more than 1% of the securities acquired by another registered investment company in any 30-day period, so that the acquiring company is less able to pressure the acquired company to do certain things by saying, if you don't do it, I'm going to sell them all the shares I own, or redeem all the shares I own. And of course, if you all of a sudden, if a fund receives a redemption request for 3% of its shares, that might cause it some considerable problems. So if one fund does own shares of another fund, under this particular subparagraph, it's restricted in the extent to which it can redeem those shares. And finally, 12D1H simply provides that the Commission may join in any action aimed at enforcing the provisions of Section 12D.
It's an interesting observation to note that there are two fund of funds in the United States now, FundPAC and First Multi-Fund. At the present time, the Commission has brought an injunctive action against FundPAC and received something in the nature of a preliminary injunction and the appointment of a special master. In the case of First Multi-Fund, the Commission has authorized proceedings against the management of First Multi-Fund. These are, as I say, are the only two fund-to-fund type companies operating in the United States at the present time.
Are there any questions on?
Yeah, Gene, the unit investment trusts, the proceeds of which, the payments of which are deposited directly into an accumulation program, is this what you were talking about under E?
Repeat the question.
The question was where you have the situation where payments are sent into an accumulation plan, and they're aggregated, and the shares purchased are put in or become part of the unit investment trust. Is this what I was talking about in paragraph 12D1E?
No, not where the shares become part of the unit investment trust. The unit holders' payments are put directly into the accumulation program, the corporate income fund accumulation program, for example. Is that what you were talking about?
No.
No.
No. No, it's what we're talking about is this. Where you have a unit investment trust which takes down shares of a mutual fund is what we're talking. There you obviously 100% of the assets of the unit investment trust is being used to buy an unlimited amount of the shares of the mutual fund. The Act, Section 12, accepted that type of relationship simply because the abuses of the fund of funds and the other abuses that we had with one investment company owning another were not evident in the unit investment trust situation. So they accepted it. It was a legitimate way of operating, assuming you didn't have a front-end load. It was a legitimate operating way of operating. And so the Congress accepted that type of relationship. It wasn't that the unit investment trust there wasn't a layering of management costs, because, as you know, a unit investment trust does not have management cost. It wasn't. You didn't have the threat of redeeming all at once, because redemption was caused by each individual unit holder wanting his money back, and not the management of the unit investment trust dumping the shares back to the fund. So none of the abuses that these sections that Dick and Gene discussed were aimed at this type of relationship. So hence the exemption here. It's really an exemption.
Okay, if there are no more questions, we'll move on to Section 12D2. Section 12D2 restricts acquisition by investment companies of interests in insurance companies. And basically it provides that an investment company can't acquire more than 10% of the securities of an insurance company unless it already owns more than 25%. Section 12D2 has to be read in conjunction with Section 12G, which provides that the Commission can give exemptions to permit sale of securities of an insurance company between investment companies for the purpose of improving the financial condition of the insurance company. This section also sounds a little arcane. The real purpose of it is that at the time of the legislation putting it into the Act, insurance companies were very concerned about the fast-growing investment company industry, and they were concerned about being taken over. And so it's there just to limit the degree to which investment companies can move in on the existing insurance industry. I should have said that there is also an exemption in 12G to permit an investment company to form a new insurance company.
History did not develop in the way that the insurance companies thought it might. And now the insurance companies are eating up all of the investment companies.
So that section really doesn't come into play all that often, but Section 12D3 does.
12D3 prohibits investment companies from purchasing securities of or any interests in broker-dealers, underwriters, or investment advisors. Now you might ask, why shouldn't an investment company be able to invest in this type of or these types of businesses? From what I've read, I believe the legislative history isn't all that clear as to exactly what Congress was trying to do here. But on the one hand, you might say Congress was attempting to prevent investment companies from exposing their assets to the risks inherent in this type of business. But I can think of riskier businesses in the broker-dealer business, and in any case, the investment company could limit its exposure to the risk of a broker-dealer or investment advisor simply by purchasing a small number of its shares. So perhaps the main reason these prohibitions were written into the Act was to ensure that investment companies had minimal relationships with those types of businesses where conflicts of interest were most likely to arise. For example, with a broker-dealer, if the investment company owned shares, the investment company may be less inclined to negotiate sharply for rates. Of course, negotiated rates didn't exist at that time. Or perhaps the investment company might pressure the broker-dealer to sell fund shares by threatening to redeem its interest in the broker-dealer, or it may develop some other type of reciprocal relationships with the broker-dealer because it owns shares in the broker-dealer.
I think that those two latter items are really the cardinal reasons, at least today, why the staff is reluctant to give exemptions in this area. One, it puts the investment company in bed with the broker-dealer, because when an investment company buys shares, he's buying shares of a principal service agent, the broker. Therefore, he will tend to give that particular broker more brokerage, because the more brokerage he gives them, the better his stock investment will be. This may even be true if even if the broker may not be the best person to execute the transactions. Secondly, as Gene points out, also, if he lends the broker money and the broker is going under and this person has a chance of losing his money, he may well pump brokerage toward that broker-dealer in order to save his own investment. So the investment company jumps in bed with his service agent, so to speak, with a person who is supplying him service, and there's a unanimity of interest, which could work to the harm of the investment company. It's to prevent that the staff is reluctant to give exemptions in this area. Plus the fact that a broker who is a big seller of securities could say, look, I'm about to float some bonds. I want to expand my operation, and I expect you to buy some. If you don't buy some, there's a subtle threat, of course, that the investment advisor will look elsewhere to have the shares of its stock in the investment company sold. This could be a tremendous threat.
Also, problems that may arise if the investment company were to own shares of an investment advisor. Or perhaps the investment advisor might recommend shares to its clients which the investment company owns in order to improve the investment company's performance, or vice versa. In order to help the investment advisor, the investment company might purchase shares recommended by the investment advisor. So there are also potential conflicts with the investment advisors. However, even though these are prohibitions, there are several exceptions, I guess, as always. In one case, and involving broker-dealers or underwriters, investment companies can own shares in a broker-dealer or underwriter where all the shares of that broker-dealer are owned by investment companies, and where the principal business of this broker-dealer is underwriting or selling shares of other companies. Also, there's Rule 12D1, which might be called the Sears Rule, I guess, which permits investment companies to purchase certain limited interests in broker-dealers.
That rule, the Sears Rule, is best exemplified by the fact that Sears wanted to go in the investment company business. And in order to do so, it had to create an investment advisor and a broker-dealer. If it did go in, 12D2 would prevent all investment companies from buying Sears stock or Sears debentures, which is not exactly healthy for Sears. So they prevailed on the commission to come up with a rule which said as long as the as less than 15% of the revenue of a company came from broker-dealers, they would give an exemption. Thank you. We'll start on the next tape.